Welcome to this brand new series where I'll be taking the covers of several technical indicators and putting them through an evaluation methodology. They'll be under the spotlight with the intention of determining which of them can help to inform a real edge in the markets. Stay tuned. Darwinex is a UK FCA regulated broker and asset manager on a mission to disrupt the financial trading, investing and asset management industries. As a trader, you'll benefit from cost-effective market access via multiple trading platforms and APIs. These enable trading and investing in any US stock, over 60 of the most liquid futures contracts, FX and CFDs. You can even diversify your portfolio by buying and selling other traders' strategies as investable assets themselves. So, if all of that sounds interesting, learn more by clicking on the link top right now or find further links in the description right below. Now back to today's tutorial. In this series, I'll be evaluating a number of technical indicators in detail. I'll be putting them through a methodology that I've used many times before for other indicators, but this will be the first time I've studied these particular ones. In this episode, I'll be taking you through the process I use to determine if an indicator is likely to help achieve an edge or not. I'm going to start with the Ichimoku indicator, for reasons that I'll explain in a moment. So let's get this series underway. The process that I'll take you through in this series is one that I've used to identify indicators that I now use in my own live trading. But there are also many indicators that I've evaluated that didn't pass the test. So this really is going to put those indicators under the spotlight. Now, before we get into any particular indicator, I want to take you in some detail through the methodology that I've used in the past and I'll be talking about in this series. And the first thing I do before anything else is to do some initial indicator research from already published articles. So to get a good idea of how typically this indicator tends to be used. And I do tend to spend quite a long time at this stage because without the thorough understanding, we can't then move on to the second stage of identifying what the target strategy premises will be that we're going to attempt to exploit with the indicator. And those of you that have heard me talk about indicators in the past will know that this is something I'm really strict about. And unless an indicator gives me a very clear idea of what the underlying asset is doing and which market phase it's currently in, then for me, the indicator is useless. I've only had any success with indicators when I use them in a way that clearly tells me, for example, we're in a pullback from a strong trend, or we're breaking out from a trading range. And unless the indicator can do that accurately and consistently, then for me, it's not worth investigating any further. And so based on that initial research, this will tell me which patterns in market price action I want to target with the indicator. Next, I move into a period of systematic analysis. And this is where I quantifiably prove or otherwise the assumptions that I made in the previous stage. If this stage then passes, I'll move on to the next stage, which will be a more thorough backtesting over a longer period of time with a much wider range of assets to see if that strategy premise holds up in a wide range of conditions with different asset classes. After this, the next stage is what I call filter analysis. And this is where I start to assess whether there's a case for this indicator to only be used under certain circumstances. So as an example, the first indicator we're going to look at is what's called the Ichimoku. And initially this was designed for the Japanese markets. And so an example of filter analysis here, we'll be looking at how the indicator performs in those Japanese related asset classes. So for example, currency pairs that include the yen, maybe the Nikkei stock index, and specifically looking at if it works better with those assets than it does on other assets. And this will help to inform how this could be traded in the future. And if all of this analysis so far proves that it's worth pursuing this particular indicator, then I move into a process of implementation planning. And this provides all of the detail around how I might incorporate the indicator into a full trading strategy. Now, as I mentioned in the introduction, I've used this methodology many times, but the indicators that I'll be looking at specifically in this new series are ones that I've never covered before. They're actually indicators that have been on my to-do list for quite some time, and I've never got around to evaluating them properly, and so I'm effectively going to be doing that real time, so you'll be seeing a genuine view of the process with results that will probably be both good in some circumstances and bad in others, which I actually think will be of great benefit to you. Now, as I said, Ichimoku, or Ichimoku Kinko Hyo, which is its full name, will be the first indicator that I look at. And this has been on my to-do list for quite some time, probably a number of years. I've never got around to properly evaluating it until this point. But why has this been an indicator that I've wanted to look at? Well, the reason is that it combines multiple indicator types into one single indicator. And in actual fact, it does address a very real problem that algorithmic traders and systematic traders encounter. And that is that when you use multiple different indicators, so for example, an indicator to give you a signal to either buy or sell, in combination with another indicator to tell you if there's a strong trend and in which direction. And the problem when you attempt to use two indicators together in this way is matching them with an appropriate number of periods so that they genuinely tell you what's happening in the price action at that moment. And getting that balance of parameters is something that is fraught with error and many traders really struggle with. But the Ichimoku indicator is different. Here, this indicator was designed to have a pre-combined set of individual indicators that have already been matched to turn the probabilities in favor of the trader. And that is what I'm going to test. Can this indicator be used as a one indicator strategy by incorporating those different elements of insight that it provides? Now, once I've gone through Ichimoku, I'll then be moving on to additional indicators, and I've got a few ideas for the ones that I personally want to investigate. But I'm also going to put a request out. If you have an indicator that you want me to cover, then please drop details in the comments below this video. But please don't just put an indicator name. What I'd like to hear from you is the detailed reason why you consider this indicator is worthy of investigation. Because as you see, the process I go through is an in-depth one, and it does take some time. And so for me, there always has to be a reason to investigate a particular indicator. So in the case of Ichimoku, for example, it's that fact that it combines multiple aspects of indicators into a single indicator. And that's the reason I want to investigate it, because it addresses that very real issue of trying to match multiple individual indicators. And so it's that rationale and that reasoning that I'd like to hear from you when you suggest an indicator. And if I agree with that, then I'll incorporate it into a future section of the series. Now, before I finish this episode, I just want to give you a very brief overview of the Ichimoku indicator. And at first sight, it looks overly complex. And many of you will know that I generally like to keep things really simple. I don't like complexity. I think complexity inhibits the ability to produce a robust trading strategy. But remember, in the case here, this is telling us several different things. And so to an extent, it has to be fairly complex. But the benefit, of course, is that you don't need to use multiple indicators because this indicator supposedly has everything we need to build a robust trading strategy. So it's built up of 5 different lines. The first of those is what's called the Chiku span, and this gives an indication of market sentiment and in particular the trend that's currently in play. Next we have 2 lines that are often interpreted together. The first is the Tenkan Sen and the second is the Kijun Sen. And translating these from the Japanese gives us what's called the conversion line and the reference line. And the way that they're used is fairly similar to the way you might use a slow moving average and a fast moving average. And when the crossover of those occur, that gives you a signal that the momentum in the market is beginning to change direction. And although these are not moving averages, that's the basic principle that's used in their interpretation. Next, we have 2 lines that are drawn in yellow here called the Senku span A and the Senku span B. And the area in between those 2 lines is what gives us what's called the Ichimoku cloud. And that's this yellow hatched area that you see here. And this is particularly good at telling us levels of support and resistance. And if I just zoom out in this chart for a moment, you can see that the Ichimoku cloud is actually drawn ahead of current price action. So let's think about the 3 main aspects that this indicator is informing us about. Firstly, it will give us an indication of the direction and the strength of a trend. Secondly, it will give us an indication of when we might want to enter or exit a trade based on the signal crossovers. And thirdly, it provides us with intelligence about support and resistance. And it's these 3 aspects of the Ichimoku indicator that has intrigued me and the reason it's been on my to-do list to investigate. Now that's just a very brief overview of the indicator. In the next episode, I'm going to be looking in a lot more detail at this first stage, initial indicator research. And so I'll be presenting to you how it's proposed that this indicator is typically used, going into a lot more detail about how the lines are calculated and why they're calculated that way, which will inform us better of how we can then interpret the information they give out. So we've now got episode 1 under our belt and we're underway with this new series on putting indicators under the spotlight. If you subscribe to the channel, then you'll get notified when each and every episode of this series gets released. So I'm looking forward to having you with me for episode 2, and until then, trade safe.